Thanks, Tom. Hello and welcome everyone to our session today with the allocators. I'm Des Johnson, CEO of Centaur in the US, based in New York. Centaur is a global independent administrator with over 180 people across 9 offices focused on fund administration and fiduciary services. I'm very excited to be joined by Tony Caruso from UTIMCO and Leo Svoboda from Nationwide. Tony, would you like to start off maybe just introducing yourself and maybe explain how you joined UTIMCO, and then we can do the same, Leo, with you?
Sure. Yeah. My name is Tony Caruso. I joined UTIMCO 3 years ago. Prior to UTIMCO, I was at Mesirow Advanced Strategies. I was head of non-directional strategies for Mesirow. Prior to that, I was at Bridgewater trading from 2007 to 2010, and I was prop trading in Chicago before that. At UTIMCO, I'm the head of the staple value hedge fund portfolio. So what that means is we break our hedge fund portfolio into two distinct portfolios. We have a directional hedge fund portfolio that targets a 0.3 to 0.4 equity beta. And then we have stable value, which targets a 0 beta. In total, it's 13 billion, the hedge fund portfolio. It's roughly 5 billion stable value and 8 billion directional. Within stable value, we have equity market neutral strategies, relative value, specialty credit, reinsurance. So it's a good mix of strategies that are diversifying in nature. Target being L plus 6% on very low risk, so 3 to 4%, low single digit volatility.
Great, thanks, Tony. Leo, do you want to go next?
Sure. So my name is Leo Svoboda, and I'm responsible for what we call liquid alternatives at Nationwide, which is our combination of equities, emerging market credit, and then also hedge funds. So our hedge fund portfolio is about $1.4 billion, spread across a couple of different business lines internally, and our focus is on delivering what we call uncorrelated absolute returns, but it sounds very similar to Tony's stable value portfolio, where we're looking to do mid to high single digit returns with mid to low single digit vol on effectively as close to a 0 beta over a 3 to 5 year look back as possible. Prior to joining Nationwide in 2017, I worked at a global macro fund where I did some execution trading as well as did all the fundamental macro research for the firm. And then prior to that, for 7 years, I was at UPS, where I managed what we ultimately called liquid alternatives, but was a similar business looking at allocating hedge funds as well as sort of using hedge fund technology to co-invest and run bespoke strategies for the organization.
That's great. Thanks, Leo, for that introduction. I guess just starting with 2020 and the crazy kind of year it was, and volatility. Obviously, we saw markets plunging, and then a quick rebound, and obviously hedge funds had to adapt pretty quickly while people were trying to work from home. And I think like the hedge fund industry did show resilience and adaptability, around that time. We saw that by the end of 2020, I think there was an increase in 290 billion in terms of the assets, which is the kind of largest assets growth in the industry's history, taken to about 3.6 trillion. I guess just your perspective from an allocator's perspective, like how did you? I guess when we think about, there are attractive headlines to allocators and investors that everything's growing, performance is great, there was a big recovery. I guess from a public perspective, just that, feeling of, is people taking advantage of the pandemic, and how are we perceived, in the public that way? It'd be good just to get your perspective, I guess, as you do allocate a lot of capital to these hedge funds, maybe start with you, Tony, what your perspective is on that.
Yeah, I mean, I guess I have a different view. I think during periods of turbulence, you see distortions as money is moving around frantically, and that tends to yield excellent alpha opportunities. And hedge funds will deploy capital into dislocations and make markets more efficient as a result. So I guess when you view it from that lens, hedge funds are providing a service to market participants. I'm not saying that hedge fund managers are angels by any means, but I mean, they're clearly trying to maximize profits. But in doing so, there are some benefits. They're doing something good for the markets. They're making it more efficient. Then the other thing I would say too is that the fact of the matter is, at least a portion of their P&L that they produce is used to help make the world a better place. I mean, in UTIMCO's case, we're using this money to fund scholarships and to fund research. So again, that's not their number one motive, but that's the fruits of their labor.
Leo?
Yeah, I mean, I guess I don't really think I don't pay much attention to the hedge funds, to the headlines about hedge funds, because they tend to all be wrong anyway. I definitely think that for once we got a chance for, in general terms, for the hedge fund portfolio to do what it was supposed to do, where instead of sort of the 2008 scenario where the majority of hedge funds, sort of took it on the chin and limped into the end of the year, people took some prints in March and then re-risked and were able to generate returns. So we did, in our experience for 2020, we actually got the diversification that we'd hoped for. We kept telling people was coming in our hedge fund portfolio. In terms of concerns about hedge funds in the public, I'll sort of use that approach more generally than just sort of speaking specifically to the pandemic. Des and Tony have now heard me say this a couple times. Who cares? We're not. I think Tony is right that at the end of the day, the organizations that are investing in hedge funds, many of them are going out and doing really important work. That's their job. The job of the hedge fund manager is to make money. And if you're really that, and so long as you're not doing anything nefarious, personal life or professional life, go out and do that and focus on generating returns for your clients. This isn't, we know you don't do it. We know hedge fund managers don't do it for free. It's not UNICEF over, on Park Avenue. But the best way to provide value is to do the thing that you're focused, do the thing that your investors, whether they're endowments, foundations, insurance companies, have hired you to do. And if it really weighs on your conscience, I'm sure lots of those endowments and foundations would be happy for you to donate a significant amount of your net worth to them.
Yeah, noted. Really good insights. I appreciate that, guys. I think just moving on to, we talked about performance or touched on performance. We saw we'd even Centaur clients in 2020, 10% return on 50% plus. The next tranche of maybe 25 or between 30 and 50, and then the next chunk, all above 20%. Obviously, that's pretty spectacular performance. And obviously you have made a load of investments. We actually saw as well, I think for the first time in probably years, that there was all inflows for all our clients for the whole of 2020, which is, you normally have kind of peaks and troughs. That was quite unique, I thought, when we looked at the data. And it'll be just interesting, I guess, looking at your investments. Did you see that same type of strong performance? Did you increase allocations in certain strategies or change things, as a result of that, when you saw, what was happening in March and how things rebounded? Maybe start with you, Leo, this time.
Sure. So we tend not to take a top-down approach with our portfolio. We try to build a balanced risk profile that we think will work through the cycle. Instead, we did lean into a couple things here. So we tried to lean into convert arb when it really widened out in March and April. We did have great performance really across the board, with the exception of a couple of quant managers throughout the course of the year. So on net, it ended up being the best performance in the history of our portfolio. Not as good as Dave Holmgren's that was featured in United. Good for him. But we were very happy with what happened. That being said, we did cut some people last year, and we've cut some people into this year. A combination of good performers and bad performers. We've looked at things where, in the depths of the crisis, how were people behaving? And did we want to continue to align ourselves with that organization? In a couple cases, we decided we wanted to walk away and reallocate capital elsewhere. And then this year, we've been looking at people who may have had a good year last year, but it was sort of their first good year in better part of a decade. So we're taking some of those opportunities. While they may not have lost money, we're taking some of those as opportunities to reallocate again to places where we have a little bit more conviction. In terms of the overall size, our allocation has stayed pretty pat, both in terms of percentage, in terms of a dollar amount, and in terms of percentage of the assets of the organization. And we don't anticipate that it's going to change meaningfully at all, because just our two big clients are an independent insurance company, a property and casualty company, and they're not growing assets in a rapid way, and they're not looking to increase their allocation to hedge funds. So we'll probably just continue to sit at the level that we're at from a dollar and allocation percentage perspective.
Great, thanks. Tony, your perspective?
Yeah, I mean, similarly, I've been in the allocation business since 2010. I've never seen hedge fund performance like this before. Everything seemed to be working. We have two hedge fund portfolios at UTIMCO, like I mentioned. We have a directional hedge fund portfolio that runs with beta, and a stable value, which runs with no beta. Both portfolios did exceptionally well last year. Directional did better than stable value because of the tailwind from beta, but there's a beta tailwind and an alpha tailwind last year. And what's really unique about those last 12 months that I haven't really seen before is every hedge fund strategy seemed to be making money, whether it be equity market neutral, relative value, credit, converts, everything was making money at the same time, which magnified performance. So I don't expect that to continue going forward. It's just a very unique environment. We have been trying to grow our hedge fund allocation. It's difficult though. Even though hedge fund performance was strong, equity markets have just completely ripped up, 60+% over the last 12 months. So it's difficult to stay at the same weighting. Our dollar size has grown, but as a percentage of NAV, it's stayed around the same. We're looking to grow stable value as a percentage of NAV. And so that that will occur over the next 2 years. But really, what's driving that is just treasuries are yielding nothing. On a real basis, are yielding negatively. So the risk reward is extremely poor. Obviously, stable value we think has better risk reward than treasuries at this point in time. So there's a big shift going on right now out of fixed income and into stable value hedge funds.
Great. And then just, I guess, shifting a little bit and talking about, digital transformation, and I guess something probably that always kind of came up on agendas, but, as you probably realize, or we all realized, I guess, was kind of slow moving due to implementation. So thinking about, we're virtual right now. We all use Teams. We all use Zoom, right? Probably actually now enjoy a phone call more than we used to because you don't have to use video. But, everyone had to adapt to that, implement it quickly. Hedge funds that actually adapt that technology will probably be more successful. And you see this kind of acceleration, obviously. Just thinking about, we heard some feedback, I guess, during the crisis that, it was hard to get allocations, from some of the pensions and foundations and universities because, you had certain mandates and how you have to do due diligence. You need physical meetings. There's articles and how they're written. How did that go for you guys, and how flexible were you, and how did you just change and augment your due diligence process? Because clearly you have to keep evaluating your managers, and you're always looking for new ones, as you both just alluded to in the last answer. Maybe start with you, Tony.
Yeah, no, we've been very active since COVID in sourcing new managers. We've added a handful of new relationships, so it really hasn't been an issue for us. We don't have any internal constraints that would prevent us from making new allocations, new managers without meeting them physically in person. We obviously use Teams and Zoom calls for all of our manager diligence. I think it added efficiency in a lot of cases. You didn't have to travel. You could have more meetings, easier to schedule. Better demos too, sharing screens, walking through systems, even presentations, I think go better actually on Zoom calls. Now what you lose, I think, is the interaction during the meeting. People are talking over each other at times. It makes it a little bit difficult. And more importantly, you can't, if you ask a difficult question, you can't read somebody's body language. It just makes it more difficult to read somebody. And then also like outside of the office meeting, in person, maybe for dinner or whatever, building a relationship, I think is a little bit more difficult, when everything's virtual. But again, we were active. We made some new investments. So overall, I don't think it really made that big of a difference.
And Tony, do you think that's going to be, I guess that's going to be part of how you do things going forward? There'll be less requirement on physical meetings. they'll be more relationship driven?
Yes. I think for updates, yeah, for introductory calls, you don't need to actually go to the office. For updates, Zoom calls are, again, I think are better. But to check in, to build relationships, like that will require, traveling out to New York or London or whatever. But I don't expect to have as many trips going forward.
Interesting. Leo, what's your perspective?
No, I mean, I agree more or less with everything that Tony said. I mean, I think at the end of the day, we've had better interactions with both new managers and existing managers by using video conferencing. The one thing that I've told people is we had a manager who, especially, I think our access to PMs has been better, and I think a lot of that is it used to be that the IR person went and grabbed the PM off the desk, and they had to sit in the office with you, and half the time they're kind of looking at their phone or waiting for somebody to call them, and there's the IR person is sort of watching the clock tick by because the PM only offered 30 minutes to come in and talk to the client, and because people didn't have to leave their screens, we didn't feel that press, and we feel like we had much better interactions with the PMs that we were speaking to, and in some cases, very, very senior people at big organizations. So that was, I really thought that was a positive. And I think that, when we look at our diligence processes going forward, I think that sort of last stand 3-hour meeting in somebody's office in New York, that's probably going away. And I think it'll be replaced by more of a focus on, okay, when we're traveling, we're really looking to, build the rapport, like what Tony was talking about, rather than, taking a day to fly up from Columbus to spend 3 or 4 hours in somebody's office just to turn around and come back. That's not going to be as big of a priority as, okay, we want to make sure that we're, seeing people out of the office, really sort of, putting in a focus on kind of volume and developing relationships rather than looking at that interaction as, a really core part of the diligence process.
Great, that's really helpful. So same for you. You didn't really miss a beat during, when you couldn't meet people physically. You pretty much switched very, very quickly to kind of Zoom, Teams, and handle things that way.
Yeah, I mean, we went to our board and we said, look, if you want us to put any money in the ground to this year, then this constraint has to be relaxed. And they were pretty comfortable with that. And once we got past that, I mean, we've done 6, just on the hedge fund side, we've done 6 investments over the last year where we haven't set foot in a group's office. We've also done 2, searches for our emerging market program that normally would have had us sort of flying all over creation to meet with investment teams for the final diligence sessions, and instead was conducted virtually, and we're actually really comfortable with how that's all shaped out. So I think it's an improvement at the margin, and both in terms of sort of the access that we're getting, but also in terms of efficiency for the team.
I would say, Leo, I don't
Really
know if you
helpful.
agree with me, but we have I guess built into positions differently. So for new managers that we haven't visited them, and we haven't done all the diligence that we used to do, we'll start out smaller, and the plan is once we can travel, once London finally accepts us, and we can get out there and do a site visit, then we'll right size it. So it's kind of I guess more timid getting in, at least for us.
Yeah, we've done less of that just because we don't write very big checks. It's a pretty small part of the overall allocation, and we have a harder time securing capacity. So we tend to, and we run a pretty diversified book. There's about 30 line items in the book. So we feel, which is probably maybe more than there actually need to be. So we haven't felt too concerned about, sort of going in close to full size versus where we were previously.
Great. I guess the next topic just around ESG, which seems to be everywhere you look. If you go on LinkedIn, you're bound to see something within 20 seconds. But obviously, big focus on the data, focus on how hedge funds are adapting, focus on the allocators and investors, and seeing, are there criteria where people will place their money. Over the last few years, I saw a big push, obviously, from Europe, Scandinavian countries, I'm not sure if that's really, formed as big a kind of push here yet. It would be interesting to get your views where that's, so topical about how does ESG get factored into decision making on allocating? Does it at all? And your view on how that should or does work. Um, I don't know if Tony, you want to start with this one?
Sure. So, I mean, the way UTIMCO is structured, so we manage money for University of Texas system and a portion of Texas A&M system. As part of our investment policy statement, we're prohibited from investing based on social and political purposes. So we don't really have kind of an ESG initiative. Many of the firms that we invest with, the external managers that we invest with, they have their own ESG factors that are incorporated to the investment process. But it's not really, we're not evaluating them based on their ESG factors. It's really just about we're trying to create an optimal portfolio that produces the best risk-adjusted return.
Yeah.
Yeah, I mean,
Leo?
Nationwide is ESG is a very important initiative for Nationwide as of this year. What that is ultimately going to mean for investments, we don't know. Well, we're still trying to figure out what that means for us as an organization, and so it's not something that's currently factored into the investment process. Obviously, you see it all over the place, particularly when you're talking to kind of equity and fixed income managers. They've all got ESG screens and ESG, teams and whatever, generally in a quest to try and add some sort of alpha. But, it's not something that we're really, we'll have to deal with it at some point, but we haven't been told how yet.
And I know you're heavy on kind of data and focusing on, how funds are operating, Leo. Do you think as well there is an element of that you'll give up some performance potentially for that ESG, rating or, approach?
Yeah, I don't know. It depends. How are first of all, I think it's an interesting question of how it's going to be applied to different types of funds, right? I mean, how are you going to decide that a global macro fund is an ESG fund or not? How are you going to decide that is options market making or vol arb, is that ESG compatible or not? I think that to the extent, if so, I think the jury's kind of still out, and it looks like from generally speaking, the academic research is kind of all over the place as to whether or not ESG is additive or not, and a lot of that has to do with definitional problems. So I don't know that, and I also think though that a press towards ESG creates interesting opportunities. I think we found interesting things that we've done in sort of green infrastructure, which is not really my book, but it's something that I am aware of that we've got going on in the portfolio. And I think markets like European carbon credits and the California carbon market and things like that are going to become, and especially if we start adopting cap and trade policies more broadly across the U.S., that could create some very interesting opportunities for investors. And you'll be sort of asked to go into it because you have this ESG mandate, but it's sort of a potentially an interesting diversified source of alpha. So I think it can cut both ways.
Yeah, that's really interesting. We have a poll actually for the audience. So just if people who want to participate, if they open up their live discussion on the right hand side, and you should see a poll there, and you can click and kind of vote. While we're still talking, I think it's going to be open for about 5 minutes. So just like switching back to I guess just the investment strategy allocation. Now we're going into this more. How do you we're seeing I guess a rebound. Things are busier. Things are open. People are out. People are planning hopefully vacations. And things even in Europe are starting to open up a bit more. I guess how does that investment allocation or strategy change for you guys as you think about it? As we come out of this, is it still? I know Tony, you mentioned directional versus the kind of base value, or does anything fundamentally change in terms of how you allocate and how you're thinking about your strategy as we move forward?
Well, yeah, I guess again, as I said before, given that fixed yields are so low and credit spreads are so tight, the utility of fixed income has has come down, has reduced. So that's the reason why we're trying to increase the allocation to stable value hedge funds. It's become more important in this environment. I guess within stable value hedge funds, we're also constantly, evaluating the changing risk reward and evolving opportunity set. I guess a good example would be just recently, right? SPACs sold off, trading at discounts to trust. And it was just a great opportunity for us to increase our exposure to that area. So, SPAC arb became actually a meaningful exposure to us, whereas it wasn't when, pricing was different. Reinsurance too. Reinsurance is a very small allocation for us, but because, over the last few years, pricing has gotten more and more attractive, we've increased our allocation to that area too. So it's always just kind of comparing risk reward across all our various options and building a portfolio in that way.
Great, thanks. Leo, is that kind of similar for you, how you think about it?
Yeah, I mean, the short answer for us is that it doesn't really change how we think about what we're doing in the portfolio. We've got a giant beta allocation elsewhere in the book, and that's what's going to that's where we're trying to hopefully squeeze that part of this trade out. I think hopefully there will be, and generally our managers are pretty diversified, so we're hopefully have enough kind of irons in the fire that we're taking advantage and we're getting exposure to whatever sort of the new area of opportunity is. I think what's going to be more interesting is as we continue to look into nichier strategies, more capacity constrained strategies, and looking at ways in order to offset some of this low yield to take kind of hedge fund strategies and hedge fund technology and apply it to more of our kind of traditional long only investing. We'll probably do more of that than necessarily try and make wholesale changes to the hedge fund portfolio.
Great, yeah, that's really helpful. Just switching to talking about fees for a second. I guess when we had a chat before, I was talking about back in 2006. I guess one client that I knew of, a client of ours, was like a 3% management fee, 35% incentive fee, and I kind of thought that was crazy. But then they raised billions. I guess I thought those days are completely gone. But what's your perspective on fees? And are those do those fees still exist? And if they were there, would you still come into a fund? Maybe start with Leo.
Yeah, I mean, Des, at the end of the day, it's a net game. So Millennium just raised $5 billion, with basically 5-year locked money at a full pass through and 20%. And they had a line out the door beyond that raise. So, people can still command that sort of premium if the returns justify it. Certainly I don't see many new launches credibly coming to market with sort of traditional 2 and 20 fee structures. I think that if you're a smaller manager, you're probably more in the call it 1.5 and 17.5 or 1.5 and 15 range, at least for some portion of a founder's share class or a new capital that's coming in. But it's a net business, and somebody at a quant shop posed a question to me one time. I mean, if you could have consistent, repeatable alpha, what should you be willing to pay away in excess of that repetitive alpha? And in equilibrium, that answer is probably 100% of it. So you try and capture as much of the gain as you can. But at the end of the day, it's are you delivering an appropriate net return to your investors, and are we getting the net return that we think is reasonable for the risk that we're taking? And that's really the question.
Yeah, I mean, I totally agree. Tony, I think there's that. Yep, I was saying I totally agree. I think there's the haves and the have-nots. I'd say 95% of the hedge fund community, 1.25 and 15, 1.5, maybe a 1.5 and 17, around that range, and the 5% that have just delivered consistent alpha over very long periods of time, they can command premium fees. You mentioned Millennium. Exodus Point 2018, biggest hedge fund launch of all time. It's passed through in 18, I think. So call it 6 and 18. D.E. Shaw opened up last year for the first time in a long time, raised $2 billion in a matter of weeks at 3 and 30. So it just really depends. But But I think there's more willingness for, again, new launches or funds that have delivered, call it like a 1 sharp or less, to revisit fees and be more creative too. What we push for is a 1 or 30 model. So we pay the greater of 1% management fee or 30% performance, not both. So that serves as kind of a hurdle, the management fee. We think that's fair typically. We think of that in terms of alpha retention. So for 1 or 30, we retain 70% of the gross alpha. And we apply an appropriate benchmark and we target 70% for the typical hedge fund. Now, when you're dealing again with like DE Shaw, Millennium, there is such strong evidence that alpha will persist going forward that we're willing to take a little bit less of that alpha. We could retain less alpha if we're pretty positive that that alpha is going to persist in the future. The bigger question mark around alpha, then we need to take more of it. So that's kind of how we think about things. Again, 70% is just kind of rule of thumb, typical hedge fund. That's what we want. If it's a lower sharp strategy, if it's alt beta, for example, we would want more.
Great. I guess like just finished up because the poll was about do really allocators like take a chance on new funds and are willing to allocate money there, and maybe to finish up our conversation, it'd just be good to hear what is your perspective on those? Leo, I know you mentioned emerging markets, so clearly there's a program there. Maybe there's smaller tickets, but what are the criteria to go and take that risk with a first-time manager? I'm sure they have pedigree, but it is a new fund with no one else is helping with the expenses probably yet, and you're coming in. Any perspective from the 2 years on that?
I'll give you the cynical answer, and then I'll try and brighten it up a little bit. For most allocator roles, there is absolutely no incentive to take a flyer on a new manager. I mean, the reality is that we talk about it in terms of career convexity. It's negatively convex, to do that, because in most allocator roles, if you make your client $100 million, you get a pat on the back. If you lose your client $100 million, you may have to start packing your shit up. My view on that is that it's a very high hurdle. I think that's why there's a place for seed funds for lots of allocators. I think that if you can, that's an interesting place for, and some of those groups do a really great job of incubating partners and helping them really build a solid business, and then introducing them to allocators in a way that sort of gives people runway so that they can get to know the firm well. And that is something that we're trying to do. We're trying to get to know firms early on in their stages. We're not going to be day one investors, but we want to be sort of first in line when they hit a couple of internal milestones for us, and we want to have kind of built that relationship over time. If you have a properly incentivized team, a really strong board and culture, then you're the kind of institution that can invest in day one with new managers. Again, the vast majority of institutional allocators are not that.
Yeah, I think we're probably in our last minute, but Tony, quick view on that.
I would say we actually are active in day one investing, and that's there certainly is higher risk day one, right? But if all the stars align, we're familiar with the manager's prior firm, his pedigree, his or her pedigree, has a track record that we can actually evaluate, references check out, and then we're compensated for that risk somehow, either via like fee economics or some other means, then it's kind of an evaluation of what's the risk, what's the reward, are we being fairly compensated? So we've been active. We don't do it all the time, but again, when all the stars align, we'll do it.
Yeah, that's great. Well, listen, Leo, Tony, it's been fantastic. Thanks for your time and all the insights. We really appreciate it. I'm going to hand back to Todd now and in the studio. Thanks.
Well, thanks, Des, and the panel for a fascinating discussion. I guess performance still matters.